In this video, we will be talking about the earnings per share. What is earnings per share? It tells us how much profit a company earns for each individual share of stock. The formula is simple: net income divided by shares outstanding. So if a company makes $2 billion in profit and has 1 billion shares, the EPS would be $2. That means each share generated $2 in profit during that period. And this is important because when you buy a stock, you're buying ownership. EPS tells you how much of the company's profit belongs to your piece of ownership. That's why EPS is one of the most widely watched numbers in investing. Now let's look at a real-world example using Marvell Technology. They reported about $1.9 billion in net income and have roughly 847 million shares outstanding. To calculate EPS, we divide the net income by the number of shares. That gives us approximately $2.24 per share. So what does that mean? It means each share of Marvell generated a little over $2 in profit. If you owned 100 shares, your portion of that year's earnings would be around $224. This is why EPS matters. It converts a huge profit number into something meaningful per share. So why do investors pay so much attention to EPS? First, it measures profitability on a per share basis, which makes it more useful than just looking at total profit. Second, EPS is used to calculate the PE ratio, price divided by earnings, which helps investors determine whether a stock is overvalued or undervalued. We will get into PE ratio in future videos. Third, it allows you to compare companies within the same industry more fairly. For example, companies like Apple and Microsoft have historically grown their EPS over time, and their stock prices have followed that growth. In the long run, earnings growth is one of the main drivers of stock performance. So what affects the EPS? EPS doesn't just move randomly, it changes for specific reasons. If profits increase because revenue rises or expenses fall, EPS will increase. That's healthy growth. But EPS can also rise if a company buys back shares. When there are fewer shares outstanding, the same profit is divided among fewer pieces, which increases EPS. On the other hand, if profits decline or the company reports a loss, EPS will fall, and that can negatively impact the stock price. That's why smart investors don't just look at the EPS numbers itself. They also check out how net income is trending and whether the share count is changing. Understanding what's driving EPS is just as important as the number itself. So here's the big takeaway. EPS is simply profit per share, but it's one of the most powerful numbers in investing. Revenue tells how big a company is. EPS tells you how much value each share is generating. If you want to think like a serious investor, don't stop at revenue headlines. Ask yourself, how much profit does this company generate per share? And is that number growing over time? Because over the long term, stock prices tend to follow earnings growth, and EPS is how we measure that growth.